If you've ever looked at a strip mall, an office building, a self-storage facility, or a multifamily property and thought, I have no idea how that gets financed, this video is for you. I'm going to walk you through commercial real estate from the ground up, what it actually is, the different property types and classes, the numbers that determine whether a deal makes sense, and why so many investors are moving into this space right now. By the end, you'll be able to look at any commercial deal and know exactly what questions to ask. Let's get into it. What is commercial real estate? Commercial real estate, or CRE, is any property used for business purposes rather than as a personal residence. The moment a property is bought to generate income or run a business out of, it moves into the commercial lending world. Different underwriting rules, different metrics, different lenders. That world breaks into two lanes that matter most for beginners. First, small balance commercial, or SBC. These are loans typically ranging from $100,000 to $2.5 million secured by owner-occupied or investment commercial property. Second, 1 to 4 unit residential investment, commonly financed using DSCR. These are smaller residential properties purchased purely as income-producing investments. Almost every deal you'll encounter as a beginner falls into one of those two buckets. Property types you'll actually see. Commercial property comes in more flavors than most people expect. Here are the property types you'll run into most: multifamily properties with 5 or more units, mixed-use buildings, commercial condos, office space, medical offices, self-storage facilities, and commercially zoned single-family conversions. Now, here's one important nuance. Multifamily units must have full kitchens to qualify. That's a real underwriting detail, not a technicality you can skip. Owner-occupied versus investor property. Before you go any further, you need to know which seat the borrower sits in, owner-occupied or investor, because the numbers change completely. For owner-occupied, core commercial properties, loan sizes typically range from $100,000 to $2.5 million. On a purchase, the maximum loan-to-value can reach 80% when the borrower has a FICO score of 725 or higher. For a cash-out refinance, the maximum loan-to-value is typically 75%. The minimum FICO score is 650. Debt service coverage requirements can range from 1.0 to 1.20, depending on occupancy and documentation type, and the required owner occupancy is 75%. That 75% occupancy requirement matters. It generally has to be sustained over a trailing 90-day underwriting period, unless the property is a new purchase or the business is expanding into the space. The metrics that actually decide a deal. Here are the numbers every commercial deal gets measured against. Number 1, net operating income, or NOI. This is the property's total income minus its operating expenses before financing costs. Number 2, debt service coverage ratio, or DSCR. DSCR is calculated by dividing net operating income by the annual debt payment. A DSCR of 1.20 times means the property produces 20% more income than it costs to service the loan. This is one of the most important numbers in commercial lending. Why? Because it tells you whether the property can pay for itself. Number 3, loan to value, or LTV. This is the loan amount expressed as a percentage of the property's value. Lower LTV means more borrower equity, more cushion, and generally an easier approval. Number 4, cap rate. Cap rate is net operating income divided by the purchase price. It's the quick way investors compare the potential return of one property against another. Underwriting method matters too. Most small balance commercial lending today uses global debt service coverage underwriting. That means the borrower's global cash flow, including all relevant income sources and obligations, gets weighed, not just the subject property in isolation. Why investors are moving into this space right now. Now, here's the timing story. Traditional banks have pulled back hard from small balance commercial lending. Tighter boxes, longer timelines, more overlays. At the same time, a wave of commercial loan maturities is coming through 2026, forcing many owners to refinance in a market where banks are saying no more often. That's created a real gap. Cash flow-based, business purpose lending in the $100,000 to $2.5 million range, a segment many traditional banks simply don't want to touch. Private direct lenders that specialize in this space, like the firm, can underwrite based on the deal's income and overall cash flow rather than relying only on the borrower's tax returns. And for the right borrower profile, no-doc and streamlined options may be available. Cash flow analysis. what counts and what doesn't. This trips up a lot of beginners, so let's make it concrete. When underwriters analyze cash flow, there's a defined list of what counts as income and what gets excluded, and those standards have become more detailed over time. For example, bank statement cash flow analysis may evaluate daily balances, monthly patterns, and zero balance activity, not just a single snapshot. And here's a practical documentation detail. Statements from digital-only banking apps may not qualify as acceptable documentation under certain lending programs. Traditional bank statements may be required. Evidence of liquid assets matters too. Cash flow tells the story of the deal. Liquidity shows the borrower has the financial strength to close, cover required reserves, and handle unexpected costs. Where this fits in the bigger picture. If you're getting into the space as an investor, a broker, or a referral partner, you really only need to know 2 products called small balance commercial and 1 to 4 unit DSCR. That's it. 2 core lending boxes. Between those 2 products, you can speak confidently about the vast majority of deals that will land in front of you. Learn the property types, understand the metrics, know which lending lane the deal belongs in. That foundation changes everything. That's commercial real estate from start to finish. The property types, the lending categories, the metrics that actually decide a deal, and why this market is heating up right now. If you want to go deeper, whether you're evaluating your first commercial purchase or exploring how to work deals like this as a partner, head to firm.ai or click the link below. Thanks for watching.